I think the issue that we actually really focus on in the report isn't the fact that it's unsecured. I think a loan in and of itself is actually quite helpful to society. The problem comes in is when those loans are very expensive. So if you look at the interest rate on these loans, they can range from 30-odd% to as high as 225%. And the point that we're driving home here is that the benefit that you derive from the loan should be higher than the total interest cost that you pay on it. And sorry, by total cost, I mean interest plus the other charges. So the problem that we have is we have a society that's taken out a large amount of loans. So 25% of retail loans that are disbursed are actually in this category, and they're very expensive. And as you said, people use them for short-term needs, emergencies. And the reality is that the returns on what these consumers derive are never high enough to offset the cost of those loans. So if I use another example, if you take a home loan out, the interest rate's not that high, probably close to around prime. And the benefit that you derive from buying a home is you don't get to pay rent. Yeah. The home also appreciates over time, and therefore you get a return that's higher than your interest cost, and you create wealth that way. The problem with these unsecured loans, particularly when the interest rate is high, is that you actually create poverty. And the aims of our report, and if you look at the discontent in society today, you mentioned the number, around 7.8 million, of which close to half are in default. I think that no doubt shows how much strain South African households are under. And we would put it to the financial service community at large, that this practice is probably a key driver of why consumers are in and feeling poorer than they should be. Another scary statistic is that these loans are actually funded by the pension funds that employees actually save towards. So if you think about it, what actually happens is your pension fund in many cases can, in some cases, invest and lend or give money to these unsecured lenders who then give you a loan. And those loans are, as I said, expensive, but the returns on your pension fund are nowhere near those interest rates.
Let's talk about the consumers for a moment. Are we seeing a clear indication of financial illiteracy when it comes to unsecured loans? I mean, are we seeing consumers get into it without necessarily reading the T's and C's or being informed about what they're signing up for?
Yeah, I think that's definitely a problem. One is that it's very hard to judge what the true costs of the loan are. So you often get quoted the interest rate. How that interest rate gets translated into a monthly installment is sometimes not clear. And there's often lots of other little hidden charges that can add up. So while the NCR limits, for example, on certain unsecured loans to be around prime plus 15, which I find fairly high in and of itself. But although the NCR limits those, you might find that a lot of lenders add a large amount of other charges, and it could be as high as another 10% to your total cost. That, together with illiteracy on